For many industries, revenue is the single most important balance in the financial statement. However, many financial institutions and asset managers may be wondering what the big deal is. Stay tuned as we think financial institutions and asset managers should be paying attention. The FASB issued a final revenue standard at the end of May 2014, which represents one of the more significant standards released in recent memory. This podcast will provide you with a high-level summary of the new standard and a discussion of some of the impacts the standard may have on financial institutions and asset managers. My name is Sean Stoker, and with me today is Chris Van Voorhees. We are both senior managers in KPMG's National Office or Department of Professional Practice. If you're listening to this podcast, I'm confident that you also participated in KPMG's four-part series on the revenue standard and are familiar with the new standard. But in case you haven't been able to do that, and really as a refresher for me, Chris, could you give us an overview of the model and maybe talk a bit about the core principle?
At the heart of the revenue recognition standard is the core principle. And that core principle is that an entity recognizes revenue as it transfers control of goods or services to the customer, the amount of consideration it expects to be entitled to receive for transferring those goods or services to the customer. So to do this, the standard establishes a 5-step model. Step 1 in the model is to identify the contract with the customer. Step 2 is to identify the performance obligations in the contract. Step 3 is to determine the transaction price. Step 4 is to allocate the transaction price to the performance obligations. Step 5 is to recognize revenue when or as the entity satisfies the performance obligation. We're not going to go in detail on each of these steps in the model, but each step can be quite involved and can have unintended consequences.
Yeah, that's a good overview. As I think about step 1 in the model, does the new standard define what a customer is?
The new standard defines a customer as a party that is contracted with an entity to obtain goods or services that are the output from the entity's ordinary activities.
Okay, that seems pretty straightforward. What are some of the challenges we see for financial institutions and asset managers when they're going about identifying the contract with the customer?
Yeah, I always think that step 1 in the model, it seems like it should be pretty straightforward and pretty easy, but it can actually be quite involved for financial institutions and asset managers. So, especially at first glance, you may think other real estate owned is not within the scope of the standard because the contract to sell or transfer the real estate are not with a customer.
Okay, let me think about it. So is that because the sale or transfer of other real estate owned wouldn't generally be considered, I guess, an output of a financial institution's ordinary activities or business?
Yeah, that's right. However, the standard includes guidance on transferring non-financial assets to non-customers. So, as a result, the new standard will apply to the sale of non-financial assets that are not an output of the financial institution's ordinary activities, including other real estate owned. In these situations, a financial institution will need to analyze the contract for commercial substance and evaluate the buyer's ability and intent to pay to determine if the contract meets the criteria to be accounted for under the revenue recognition model. I want to highlight, this is different than current GAAP, which is under ASC Topic 360, which has a prescriptive set of requirements to recognize revenue. And this may actually result in entities recognizing revenue sooner under the new revenue standard than they do under current GAAP.
Yeah, so that sounds like some potential implications for financial institutions. What about asset managers? Are there any challenges that we see or that we've thought about for those entities?
So an asset manager enters into a contract to provide advisory services. Usually that's with a pooled investment vehicle. So those advisors will have to evaluate whether the contract's with that pooled investment vehicle or whether it's actually with the underlying investors in the pooled investment vehicle. So I think this will require entities to consider the specific facts and circumstances of their contracts. It will have implications as we go through the model, but it really requires a lot of judgment.
Yeah, so it sounds like it's going to be really important to determine whether the customer is the fund or the investor. Are there some examples of the factors that should be considered when we're making that determination?
Yeah, again, I can't highlight this enough. That's based on the specific facts and circumstances of those contracts. But some general factors that I think entities should consider are who's the contract with. Is there a board of directors that approves the contract, or is that up to the individual investor? Are there a number of investors in the fund, or is the fund really established for a single investor?
Okay, let's maybe move on to step 2 in the model. Can you help me with step 2, which is, if I remember right, identifying the performance obligations in the contract? What are the potential issues we see there?
One issue that I like to highlight relates to credit card loyalty programs. Before I go into this issue as it relates to the revenue recognition standard, let's walk through an example. And let's say you want to buy a new iPhone. It just came out, you're really excited, and you decide you want to purchase the model that costs $300. And you're going to use your credit card to purchase the iPhone, because you get one loyalty point for each dollar you spend. And you have your eye on this brand new shiny toaster that you want to redeem your loyalty points to get. So entities that take credit cards pay something that's called an interchange fee for each transaction. In this example, let's say the interchange fee is 2% of the price, or $6. So in my example, Apple will get $294 of a $300 transaction price, and they pay $6 to go to the interchange fee. A portion of the $6 interchange fee will go to the acquired bank. Let's say that's $1 in the example, and the remaining $5 will go to the bank that issued the credit card. So the bank will retain a piece of that $5, and they'll use another portion of that $5 to purchase your loyalty program. Again, in my example, the shiny toaster. And this really raises questions as to who the customer is related to the interchange fee. Is the cardholder the customer for the interchange fee because they are receiving the service of electronic transfer of funds? Or alternatively, is the merchant the customer for the interchange fee because they are paying the interchange fee to allow their customer to buy the good or service? If the cardholder is the customer and a separate performance obligation determined to exist for the credit card award points, a portion of that interchange fee may need to be allocated to the performance obligation and actually deferred until redemption occurs of the loyalty points. So until I redeem my toaster, you may not get to recognize a portion of that interchange fee.
That's an interesting example. I think probably something that folks may not have been focused on when they heard about a new revenue standard. Is this something, are we aware if this is something that the boards discussed how credit card companies would determine if there was a separate performance obligation for credit card reward programs while they were deliberating the new standard?
Yeah, this actually came up at a meeting in May 2013, and the board has noted that in all arrangements, including, for example, where there are more than two parties to an arrangement, the entities in the arrangement should consider all the facts and circumstances in applying the revenue model to determine whether the promise to transfer award credits gives rise to a performance obligation to the card issuer. The board indicated that each entity would need to evaluate the specific facts and circumstances of the arrangement.
It clearly sounds like there's going to be some judgment involved here when you're determining whether or not the credit card loyalty program constitutes a separate performance obligation, or at a minimum, perhaps further implementation guidance might be necessary.
That's right, Sean.
Okay, well, let's move on to the next step in the model, which is determining the transaction price. Under the new standard, there's a concept of a constraint on variable consideration. Any impact there from an asset manager perspective?
The model is going to change how asset managers account for performance-based fees compared to current GAAP, which has two acceptable methods. Method 1 under current GAAP allows them to recognize revenue at the end of the contract. So you just wait till the end of your performance contract and you recognize revenue for performance-based fees. Method 2 allows an entity to recognize the amount that would be due under the contract if the reporting date were the end of the contract period, even though it may be subject to reversal in later periods. Under the new standard, asset managers with arrangements that include performance-based incentive fees, again, this is variable consideration, so they'll be subject to guidance under that variable consideration, including the constraint. The recognition of these fees will be limited to the amount for which it's probable that a significant reversal in the amount of cumulative revenue recognized will not occur. So when they're making that assessment, they need to consider factors such as market factors. And the standard says that they may not be able to estimate those, and they may be so significant that they may not be able to estimate those because they may result in a significant reversal of cumulative revenue recognized.
So would entities ever need to reassess if the consideration was probable of not having a significant reversal?
Asset managers will need to update their assessment each reporting date. And this may result in some asset managers recognizing revenue for performance-based incentive fees only at or near the end of the contract period.
Okay, you mentioned earlier that there were two methods under current GAAP, and the new model you just described sounds a lot like method 1 under current GAAP. Is there a difference?
Under method 1 of current GAAP, then you would need to wait till the end of the contract to recognize revenue, regardless of whether or not it's probable that a significant reversal in the amount of cumulative revenue recognized would not occur. So let's go through an example I think this will highlight it. If an entity had a performance-based fee and set a hurdle at, let's say, 10%, let's say the entity exceeded that hurdle by 20%. So they've got a 30% return, the hurdle rate was 10%. They're 9 months into the contract in my example. If the entity decided after those 9 months to transfer the assets to a money market fund for the remainder of the contract term, the entity may conclude that the variable consideration related to the performance fee was not subject to a risk of significant reversal and include the variable amount and the revenue before the end of the performance period. This will result in earlier recognition of the revenue than under method 1 under current GAAP, which would require the entity to wait till the end of the contract term to recognize revenue.
Okay. I know we're talking about a revenue standard here, But I thought I also heard that there was some discussion potentially about cost. That could potentially impact asset managers. What are we thinking about with respect to asset managers and cost?
Under the new standard, incremental costs to obtain a contract with a customer are required to be capitalized if the entity expects, one, those costs to be recoverable, and that amortization period is more than 12 months. This will change current practice for some entities. I do want to highlight that the new standard does not change current GAAP cost guidance for mutual fund distributors with those fees where they pay a distributor, and there's also a 12B1 fee and a contingent deferred sales charge. The FASB actually elected to retain that specific cost guidance as part of the new standard.
Great. Chris, I think you've really highlighted here where financial institutions and asset managers need to be paying attention to the new revenue standard. Let's get away from some of the accounting and just, can you touch briefly on, are there any changes with respect to disclosure requirements?
Disclosures are going to be expanded significantly. There are quantitative disclosures that will be required quarterly, including disaggregation of revenue, information about contract balances, contract costs, and the transaction price allocated to the remaining performance obligation. There are also several qualitative disclosures. And I want to highlight that even if you've listened to this whole podcast so far and you said, I don't think that I'm going to change how I recognize revenue, as you're thinking through this, there may still be some significant implementation issues related to systems and processes and controls that you should be thinking about for the disclosure requirements here.
We should probably also talk about when the new standard becomes effective and what the transition options are so folks know when they need to start to prepare for this.
So for public business entities and certain not-for-profit entities, it'll be effective for annual periods beginning after December 15, 2016. So that's 2017 for calendar year-end companies. U.S. GAAP early adoption is not permitted. For all other entities, they get a 1-year deferral. The standard includes 3 transition approaches. The first is full retrospective, which requires the company to recast all contracts for all periods presented in the financial statements. There's retrospective using one or more practical expedients. The third transition option is the cumulative effect at date of adoption method. And this requires an entity to record a cumulative effect adjustment at the beginning of the year of adoption. Under this method, an entity is required to provide disclosure in the period of adoption of the impact of the change on each financial statement line item. This requires the entity to account for revenue transactions under both the new standard and legacy GAAP in the year of adoption to determine the effect of the accounting change.
Thanks, Chris. This has been really helpful and I think really highlighted the potential impact of financial institutions and asset managers, as we mentioned before. For additional information, you can refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG's analysis of the new standard. It includes our defining issues, webcasts, and other podcasts, which include the 4-part series we mentioned in the beginning.